Okay, good morning. Time now, a few minutes after 8 a.m. In Tokyo, November 4th, Friday, 2022. Welcome to another edition of the World Bank online morning seminar organized by the team based in Tokyo. My name is Koichi Omori. I am Senior External Affairs Officer of World Bank based in Tokyo. We are featuring the almost all regional economic updates in the past several years as each of the regional chief economist office published the regional economic update with a deeper analysis on the key thematic topics every spring and fall. This fall, we have already featured 4 regions. This is the 5th region we are going to feature this morning, Europe and Central Asia. With us connecting from Washington, we have 2 economists presenting the main point of the report. Let me introduce 2 of them. First, we have Colette Wheeler, who is a senior economist, Prospect Group of the World Bank. Good morning, good evening to you. Thanks for joining.
Thank you very much. It's a pleasure.
Great, thank you very much. And also we have Ivan Ture, who is economist from the Office of the Chief Economist for Europe and Central Asia region for the World Bank. Welcome back to this program, Ivan. Thank you very much for joining.
Thank you for the invitation.
Great, thank you very much. So the next 30-40 minutes, we'll listen to both Colette and Ivan to present the main point of the latest edition of Regional Economic Update for Europe and Central Asia. After that, we received some questions from the audience, so I'll read those questions, asking both of them to respond. If you did not have opportunities to send your questions, as usual, please send your question by online form posted on the announcement page, or simply post your question on the YouTube screen. With that, I would like to ask Colette and Ivan to come in to formally start your presentation. Over to you.
Thank you, Koichi. I'm going to now share the screen of the presentation. Tell me, does it look correct? So, yes. Well, thanks again to the Tokyo office for inviting us to present the fall 2022 ECA economic update. The featured topic of this economic update is, as the title suggests, social protection for recovery. I am Ivan Torre from the Office of the Chief Economist, and my colleague Colette Wheeler from the Prospects Group will start this presentation by focusing on the first part of the update, which discusses the macro outlook for the region. The future chapter on social protection follows, and I will present it. But let me mention also that in this edition of the update, we also have a companion piece, a policy note on the energy crisis, which focuses on how to protect economies and enhance energy security in ECA. This policy note is not included in today's presentation, but you're most welcome to visit the website of the ECA Economic Update, and you will find there a link to the policy note, which discusses, as I said before, some short-term policy recommendations to respond to the current crisis driven by high energy prices. So without much further ado, I will leave the floor to my colleague Colette to present the first part of the update on the macro outlook for the region. Thank you.
Ivan, and thank you again to Koichi and the Tokyo office for this kind invitation. So much has happened since we last presented in April in Europe and Central Asia, which we call ECA around here. And so largely the developments have been quite mixed. So I'll start first with the positive developments. So on the positive front, since we last presented, we are now expecting a much softer contraction in output in 2022 at only 0.2%. So a negative contraction, so negative 0.2% for this year's output in ECA. Plus, prior, we had 6 regional economies expecting to contract, and now we only have 4. And those are the countries that are really hard hit by the war directly or through international sanctions from the war, or who are close neighbors. So that's down from the number of countries we had anticipated to be in a recession this year. So that's been positive. We also saw activity stabilize much faster than we had anticipated back in April, as well as financial markets too, in ECA, that is. And for Ukraine, we also saw some stabilization in activity, which is very reassuring. This largely reflected a swifter containment of the conflict to the eastern part of the country, as well as a partial, albeit modest, resumption of grain exports from the Black Sea. Now, for Russia, the estimated fall in output in 2022 is only about half as much as we had previously projected. Now, this is because of a few different reasons. First of all, there was larger than expected fiscal support packages, as well as higher than expected oil production. And this was in large part due to export diversion, especially at discounted prices to purchasers outside of Europe. We also had financial market conditions stabilize, as I mentioned, and this was due to a combination of rapidly enacted and extensive capital controls, as well as liquidity operations done by the Central Bank of Russia. And as well as the maintenance of the ruble's exchange rate, that had helped to at least contain some of the inflationary pressures, as well as the losses in real income that we had expected and were not as bad as it turned out. So now turning to the bad news, well, unfortunately, we have revised down our forecast for Europe and Central Asia's growth in 2023. Essentially, we are expecting output to remain flat, expanding only 0.3% next year. This reflects two things. First of all, this is some of the weakness that we had anticipated to hit in 2022 has actually been shifted to 2023. For example, there were delays in, for instance, the EU oil embargo on some of the oil coming out of Russia. Those are now anticipated to be fully in effect by early 2023, rather than previously assumed at some point in Q2 or Q3 of this year. Second, we've had quite some negative developments that are going to affect the outlook going forward. And even since we published a few weeks ago, there's been even more downside news. So let's turn to the next slide and have a closer look at what's driving the outlook. So since we last presented in spring, there have been quite a few negative developments, as I indicated, and we're really anticipating this to dampen the outlook for next year, which is why we have downgraded growth for the region next year. First, we have seen an energy crisis unfold. As Ivan mentioned, there is an energy note, a companion piece that was put out alongside this report. I highly recommend it for those interested in the policy ramifications of the energy crunch in Europe. On top of that, of the disruption of the supply of energy related to the invasion, that has dented confidence, that's dented economic activity indicators, not just in ECA, but in its largest trading partner, the Euro area. So this has had a twofold impact on ECA. So it's had an impact directly, as well as through negative spillovers from the Euro area. And this brings us to the Euro area, which is the region's largest trading partner, actually the region's largest economic partner at that. We've seen private sector forecasts move down over the past few months for the Euro area, and they are pointing to a contraction in output, at least for 1 or 2 quarters, possibly for the year as a whole. And this is despite a slightly better outturn of Q2 and Q3 data this year. But what's important to note here is that this would be the second contraction in only a few short years. And so this downturn is quite damaging for the region's economies because of their reliance as an export destination for Europe. And again, this is because of the energy crunch that we're seeing, ongoing spillovers from the invasion, and a deteriorating global picture. Now, on that point, on the deterioration in the global environment, we've seen it become especially pronounced in recent weeks, especially when looking at forward-looking indicators for confidence as well as activity, PMIs, et cetera. This has largely reflected weakness in the world's three largest economies, the United States, the Euro area, and China. And I already mentioned the Euro area, but as far as the United States go, we see rapid monetary policy tightening as the United States tries to tame these inflationary pressures. And then that's more broadly spilled over into the global economy more generally. We see global financial conditions, they've tightened. And what this does is it really increases the risk that we could see some financial pressures emerge in our economies and even outside of our economies, as we saw in the United Kingdom more recently. We also have subdued growth in China. This is reflecting all sorts of pressures from both the real estate sector as well as COVID-related disruptions. And this is really important for the ECA region because the eastern part of the region, particularly countries in Central Asia, are quite dependent on China as an economic partner. Of course, all these global factors have been exacerbated by the invasion of Ukraine. And in some sense, things have somewhat worsened since we published. We've seen an uptick in geopolitical tensions. We've seen over the past week or so a temporary lapse, for instance, in the agreement regarding Black Sea grain exports. And of course, these developments have negative repercussions for the outlook, including for inflation, which continues to accelerate in the region, in large part due to high energy and food prices, and despite early monetary policy tightening in these countries. So going to the next slide, as I mentioned, we have really seen a lot of volatility in the energy markets this year. Although they have come down a bit, actually quite a bit from their earlier highs after the invasion, they still remain quite elevated, especially relative to a year ago. And the price directions have actually begun to diverge between oil and natural gas. And since we published, we've seen Brent crude oil prices rise further from about $84 per barrel in late September to around $95 as of today or yesterday. So this recent uptick in crude oil prices has largely come on the back of the OPEC announcement to lower their production target by about 2 million barrels per day, which is about 2% of the global supply starting in November this month. But the actual cut in production will likely be a bit smaller, as many OPEC members and their partner countries are already below their targets. But still, this has pushed up oil prices in recent weeks and since we published, actually. Now, in contrast, we've seen European natural gas prices decline further since we've published. It does still remain about 30% higher than the price level it was in January. But at one point, this was many times larger. So we've seen a positive development in that direction. And this largely, the fall in natural gas prices in Europe, it in part reflects easing concerns, for instance, about supply shortages. We saw the EU storage facilities reach almost 90% by end of September. So that is what took some of those price pressures off regarding natural gas. And we also saw that the replenishment of natural gas supply was supported by mild fall weather, as well as alternative pipeline supplies, particularly from Norway, and increased LNG imports from the United States. But there's a lot of uncertainty going forward, so of course this could change very quickly. And from an ECA perspective, as I mentioned, there's a lot of detail on these market developments as well as the policy response options in the companion piece that I then mentioned. Now, turning to the next slide, what we looked at in particular with respect to this energy price shock is what this would mean for Europe and Central Asia, especially for the European Union countries, as they are a large economic partner of the region. And they are directly impacted by the energy supply disruption from Russia. So we looked at some estimates and to see what kind of impact that could look like if there's a full cutoff on the energy supply. And of course, there's a wide range, and a lot of this depends on the assumptions built in, whether it's a colder than average winter or an average winter or a mild winter. But in large part, it seems that the dent to output levels could be about 2% of GDP. But I'll get back to this later. We did extend this exercise to our ECA countries with respect to growth scenarios. So turning to the next slide, we've seen a lot of developments in the financial markets. Even since we published, again, we've seen a lot of volatility, not just in energy markets, but also on the financial side. Global financial conditions appear to have tightened further. Market-based expectations, for instance, for the US policy rate have risen further since even yesterday's Federal Reserve decision to increase the interest rates. That increase was broadly in line with market expectations, but still nonetheless, markets have responded. And it seems that future traders are now slightly lifting their expectations for the Fed's terminal rate to about a peak benchmark, overnight benchmark rate to over 5% in June 2023. It seems like the yield curve has also shifted out, and that is to say that the market now expects interest rates, at least on the United States side, to be higher for longer. In the euro area, markets expect a downturn despite a less aggressive monetary policy tightening cycle and later tightening for that matter. Again, this relates to the energy crunch, as well as all the confidence effects from spillovers from the war. But in general, the market expects the ECB to continue to tighten policy rates from their current 1.5% or thereabouts to peaking at just below 2.9% in 2023. And so, of course, what this all means for ECA is that global financing conditions, when they have tightened like this, is that it amplifies the tightening cycle that we have that's ongoing in ECA. This has been exacerbated, for instance, by currency depreciation pass-through, as well as elevated domestic policy uncertainty in some countries and geopolitical tensions. And this all puts pressure on capital outflows from the region. It puts currency depreciation pressures on countries in the region as well, which is what you see in these charts here. And so moving on, one of the large ramifications when we have these financial conditions tightening is that fiscal policy space and risk management need to be carefully calibrated, especially in the context of servicing debt following sharp increases in debt levels like we saw in response to the pandemic. And the countries that tend to be the most vulnerable to these sharp market reassessments are typically those with already high levels of debt and already high debt servicing costs, especially when the debt is largely held externally in foreign exchange currency or with shorter maturities. And so we could see some stress going forward if downside risk were to materialize. At this point, I'll be clear, there is not financial stress at the moment in the region. A lot of that has been averted, thankfully. However, that risk still looms large, especially against the context of a really sharp tightening cycle at the global level that is quite synchronized, to be honest. So that's a key risk. And then that also feeds into, so if we go to the next slide, to the inflation front, which is what's driving all these central banks to hike their policy rates. And in ECA, the median and headline inflation has increased further since we published. I checked data today, and it looks like that we are already beyond 15%. median inflation year on year. So that is putting us at about the highest pace, the fastest pace rather, since the late 1990s. And we've seen this across the region too. It's not just contained to one or two countries. This is quite broad-based. We see inflation that continues to significantly exceed central bank targets, for instance. And core inflation is also rapidly accelerating, which stokes concerns that this could be entrenched for a longer time and increases the risk of a de-anchoring of medium-term to long-term inflation expectations. So in response, the region's central banks have continued to tighten. About 80% of the region's central banks have continued to do so this year. There are one or two outliers, of course, but for the most part, the tightening cycle has continued in ECA. But one of the key problems with the high inflation, especially from a World Bank perspective, is that it has really carved into the incomes of the poor. For vulnerable households in particular, they spend more money on these items, and this has in turn contributed to the sharp uptick that we saw from poverty from the pandemic. So this is just layering on additional effects and challenges for the region. And so turning to, let's actually skip the next two slides, Evan, in the interest of time. Perfect, thank you. So let me recap a bit of what our outlook is. So for this year, for 2022, we are expecting output in the region to contract, so a recession in annual terms. And this is because of the invasion of Ukraine. In 2023, the picture has deteriorated. It does not look great. Output in ECA is expected to remain virtually flat with growth of only 0.3%. At 0.3%, this is a downward revision of about 1.2 percentage points from our previous forecast that the World Bank released in June. It's important to point out that while much of this weakness is emanating from the decline, a further decline in Russia, forecasts for 2023 growth have been downgraded across the board in at least 70% of ECA's economies for next year. So again, this reflects the energy supply cutoff. This reflects the downturn in the euro area, just a weaker overall global outlook, and significantly tighter global financing conditions, which are having a large effect on all of our partner countries. So we're expecting that in all for 2023, output levels will fall to about 6% below what they would have been expected to reach before the pandemic. So this is quite a significant shock to the ECA economy and implies some longer term scarring. So going to the next slide, with this weak outlook already projected as the baseline, we could actually see a worsening of that. There are many factors that could lead to a materialization of some key downside risks to the region. For instance, we could see geopolitical tensions further escalate, energy could be further disrupted, or a colder winter, for instance, could mean a quicker depletion of those energy stores. Inflation could continue to surprise on the upside and cause an even more rapid and aggressive tightening in global financing conditions. And in turn, from a combination of factors, we could see the materialization of financial turmoil, financial stress, especially in vulnerable economies. And then lastly, let me just quickly mention what the materialization of one of these risks would mean for our outlook. So if we go to the next slide, what we did here is we modeled what the impact would be from a complete cutoff of energy supplies from Russia to Europe, and in such a way that it would cause the baseline from our energy prices for European natural gas to rise significantly. And that we would also see a deeper downturn in the euro area and a shock in financial confidence. And this in turn would trigger a deeper contraction in 2022 and then slide into 2023 and have another contraction in output in 2023. Should this occur, we could see the third annual contraction in output in only a few short years, of course, being 2020, 2022, and 2023, implying scarring to output at least over the forecast horizon, but most likely in the longer term. So even in our baseline case, where we're expecting incredibly weak growth next year, this points to the need to ensure that policy is put in place to protect the most vulnerable populations from these adverse shocks. And for that, I turn to Ivan, who is the expert in this area and will walk you through the results of part 2 of the report. Thank you.
Thank you very much, Colette. And as Colette was saying, in this context of repeated shocks, it's important for countries in the region to have a solid and resilient and adaptive social protection system. So why do we focus on social protection for this economic update? So beyond the short-term shocks that the region has been facing, there are longer-term trends that are affecting the region. First of all, there's an increasing acknowledgement of the role that systemic risks play in driving poverty and vulnerability. There are these mega trends like globalization, aging, green transition, and technological change of different kinds that are transforming the European labor markets. They are altering their institutional and contractual arrangements, and they are creating disparities and vulnerabilities in different segments of the labor force. Social protection systems will need to be reformed to address these new challenges and provide adequate protection to workers and families in this new context. So in this economic update, we do 3 things. The first is that we analyze the effectiveness of the social protection systems in addressing sudden shocks, like the pandemic, or more recently, the challenges of the war in Ukraine, for instance, the increases in energy, food prices, and the refugees. In this update, we also take a longer-term perspective, a look at the evolution of labor markets in ECA and how their transformation may risk leaving vulnerable groups unprotected under the current structure of the social protection system. And lastly, we discuss policy options for SP system to ensure adequate protection while allowing countries to adapt to the structural changes in the economy. So let me start by showing you how do the social protection systems of ECA compare to the world. So the social protection systems of ECA are among the largest and more generous in the world. In fact, in 2019, in the eve of the pandemic, the countries in ECA spent around 13.5% of their GDP on social protection. If we focus only on the emerging and developing economies of ECA, this expenditure was 9.6% of the GDP. The global average is 8.7%, and in particular, the global average of emerging countries is 6%. So you can clearly see that the ECA region already spent much more than the peers in other regions of the world. Then the pandemic hit. What was the response to the pandemic? Well, like most countries in the world, ECA countries implemented social stimulus packages. These stimulus packages were on average around 5.3% of GDP for emerging ECA countries, which was around the average of the world, which was 5.6%. But an important characteristic is that ECA countries spent quite some amount of their fiscal stimulus on social protection measures. So globally, the average size of the social protection response packages to the pandemic was 2 points of the GDP. In emerging countries of ECA, it was 2.3. And if we include higher income countries in the region, it was 2.5%. And as you can see in the graph here, the social protection measures accounted for more than 80% of the total fiscal stimulus packages implemented in response to the pandemic in Eastern Europe and the South Caucasus, while non-SP expenditure was the bulk of the stimulus in Northern, Southern, and Western European countries, which are the richer ones. That is, in the middle and low-income countries in the region, social protection expenditure represented the biggest type of fiscal stimulus implemented in response to the pandemic. How can we characterize social protection response to the pandemic? Well, there are two approaches. On the one hand, policies can protect income of workers or individuals in the face of a shock. These income protection policies are cash transfer programs, cash-based social assistance, unemployment support, social pension. Another approach is to protect the jobs, the work, the employment of individuals. And the kind of policies that go in that direction are short-term work arrangements, subsidized furlough schemes, wage subsidies, firm liquidity support. So all countries in ECA implemented both types of policies, but the relative weights of which on which they spent more also depended a bit on the perception of the nature of the crisis. So if the crisis is perceived as a short-term crisis, then maybe job protection policies to just basically, freeze the structure of employment in the short term are more adequate. And they prevent the destruction of jobs. But if the crisis is perceived to have more of a structural impact, then one may well let, some firms and jobs disappear, but at the same time protect the income of individuals. So both approaches aim to protect workers and promote growth. As I was saying, job protection policies are considered to be more effective for temporary shocks, and income protection policies are more suited to longer-term change. So what worked better after the pandemic? So we created this database of social protection expenditure in the pandemic using as a base database that was created by Ugo Gentilini and his colleagues from the Social Protection Global Unit, which collected all the measures that were implemented by countries in response to the pandemic. And we classified every category, every type of measure into two focus groups: income protection or job protection. And here you can see a detail of which policies we included from this database as income protection and which policies as job protection. We complemented this data set of Ugo Gentilini with our own original research on the expenditure of these programs, because the database didn't contain that information. And based on that, we could have a picture of how much money did countries spend in each type of policies. And here you can see in this graph the distribution of the expenditure in job protection policies, which are in red colors, and income protection policies, which are in blue colors, along the income level of countries across the world. So here you can see that the countries on the left side of the graph, which are the poorest countries, spent almost all the social protection budgets on income protection measures. As countries become rich, the richer countries spend more on job protection policies, the ones that are colored in red. So there you can see that upper middle income countries, which are the bulk of the countries in the ECA region, are in between, in the sense that they spend both on income protection and on job protection. And how does it look within ECA? So first of all, let me just give you a top level number that in ECA, as I said before, the average income protection package, social protection package was around 2.1, 2.2% of the GDP, of which 1.3% was spent on income protection and 0.9% on job protection policies. In non-ECA countries, the average of expenditure on income protection was about the same, 1.4% of GDP, but there was much less expenditure on job protection policies in non-ECA countries. So the first characteristic of ECA countries' policy response is that they spent quite a bit on job protection policies. And then you can see in the graph the regional variation. There is a lot of sub-regional variation. You have like countries, like regions like Central Asia, where almost all the social protection budget was on income protection policies. But then you have other regions like Central Europe, for instance, that spent quite a bit on job protection policies. And the relevant point here about the ECA response is that you can see that in all regions except for Central Asia, there was some expenditure on job protection policies, even in those countries with high rates of employment informality. And you must understand that usually job protection policies cover only formal workers. So even in countries where formal workers do not represent a big part of the employment, still countries implemented fiscal measures to protect them. What was the impact of the SP programs, the SP response on the ECA economies in the short run? So here are just some correlates on the horizontal axis. You have the percentage of the total social protection budget that went to job protection. And on the vertical axis, you have different outcomes, economic outcomes. You have the short-term GDP growth between 2019 and 2020, the change in employment rates over the same time, the change in the inactivity rate, and the change in the poverty rate. So in the short term, the more countries spend of their social protection response budget on job protection, the smaller the decreases in employment were, the smaller the increases in inactivity and poverty rates, while for the GDP, it wasn't very clear. So overall, in our analysis that we present in the report, we show that, both types of policy approaches, income protection and job protections, can have welfare improving effects. But in the short run, higher expenditure on job protection was associated with better outcomes. Though we must qualify this to say that this effect was significant only in countries where pre-pandemic social insurance system was relatively weak. In countries where the social insurance system was quite wide, we had a broad coverage before the pandemic, then we didn't find a significant effect of either type of SP spending. And this partly relates to the fact that countries that have a broad system pre-existing already have some kind of automatic stabilizer in place, because these systems of social insurance precisely react to shocks. Therefore, only in countries where these systems were really weak, these measures make a difference. And let me finish by mentioning that we did also some analysis at the firm level, and we found that job protection programs appear to have hindered labor reallocation from less productive to more productive firms. So even though we had in the short term, a relatively positive effect of job protection policies on economic outcomes, this effect we found on the firm level suggests that these type of programs may have a negative effect on economic efficiency, which could be damaging for the long term. So as the region was recovering from COVID, another shock hit, the war in Ukraine and its consequences, and the social protection systems had also to react to this. So the first shock for many ECA countries, particularly those in Eastern Europe, was the arrival of millions of refugees from Ukraine. And so far, they have more or less successfully provided refugees with immediate food and shelter. But over the medium and long terms, countries will need to accommodate them in ways that ensure their well-being and also the well-being of the host communities, which is particularly important in this context. For this, it's important for them to integrate into the local communities. And for this to happen, not only have they to be provided with the legal right to work and they have to be provided with education, but also the host communities need to be receive investments that that can help to prevent congestion in the use of public services, which usually can lead to some backlash against the arrival of refugees. So the other shock, which still has failed to materialize completely, but there is a risk, and more as the conflict extends, is the impact that the war could have on Central Asia via the return of migrants from Central Asia that work in the Russian Federation. And the fact that the economies back home, the households back home, usually rely a lot on remittances. So as Colette mentioned in the first part of this presentation, the negative outlooks about the Russian economy didn't materialize, but they may actually materialize in 2023. So this is something that policymakers in the region will need to be aware. There's a possibility that Central Asian countries will have to grapple with a social protection crisis driven by the arrival of migrants that who are currently working in the Russian Federation. And also the last bit of this shock, which is in the news these days, is the increase in food and particularly energy prices. So far, fortunately, the disruption in the international agricultural market has not translated into increased food insecurity in ECA, although there are concerns about affordability, but it's the energy crisis that is really taking the attention. And for this, I will defer you to the policy note that I mentioned that you can download from the website of the report. So in the background of these shocks, of these repeated shocks, there are long-term trends. And let me point out here what are these longer-term trends that are changing the labor markets in the region, and that they may affect the way the social protection system, which so far appear to have reacted relatively well to the shocks, but they may not be the best suited to deal with these changes in the labor markets that are happening. So ECA social insurance schemes are funded mostly by contributions from individuals' labor earnings. These contributory schemes were designed when the full-time permanent employment was a norm, but technological change, globalization, digitization, and regulatory reforms to accommodate them have affected labor mobility and job stability. So standard employment is giving way to non-standard forms of employment. And even if wage employment relationships remain most prevalent, their duration has shortened. So these changes in the labor market weaken the relevance of these employment-based contributory social insurance schemes that are prevalent in the region. And these risks leaving many households and individuals unprotected. In fact, non-standard employment has been increasing. Non-standard employment, which includes part-time work under temporary contracts, agency work, and wage work with no legal contract, has been increasing in the region, and it affects particularly the young. Today, about 40% of young workers in ECA have non-standard forms of employment, have a non-standard type of employment. At the same time, the average time that individuals spend in a job has been declining. So this increased prevalence in non-standard employment is also associated with an increased turnover and shorter tenure of jobs. If we do an age period cohort decomposition of labor of job tenure in the ECA region, we find that the younger cohorts have a considerably shorter job tenure at every point of their professional lives. For instance, in the EU, workers born in the 1980s have on average a tenure in their jobs that is 3.3 years shorter than those born in the 1950s. This is 4 years shorter than Russia, 4.7 years shorter in the Western Balkans, and up to 7 years, almost 8 years shorter in Turkey. Actually, in this graph here, you can see the difference between the average tenure for those born in 1950s and those born in the following birth cohorts. So at every point in their professional life, the average job tenure for the younger cohorts is declining. What is driving this? So first of all, let me just mention on top of this that tenure is also declining faster for the women, apart from the young. And also the less educated have seen a decrease in the probability of having longer tenures. So we did some analysis and we find that part of the reason why tenure appears to be shortening is that there is weaker employment protection, and this is something that has already been found in the literature. There's evidence that the reforms done during the 90s to accommodate the pressures of technological change and globalization eventually resulted in a weaker, in more turnover. Technological change also is associated with shorter tenure in globalization and trade openness as well. So, as I said before, these employment-based risk-sharing models in the social insurance systems are not well adapted to the transformations of the labor markets in ECA that they are going through. And in fact, independent workers, for instance, receive fewer illness and injury benefits, fewer unemployment benefits, and lower old age pensions than those in standard employment. And similarly, here there are some more specific data points there on what do the current systems, imply for, workers in these non-standard or non-standard employments or that change jobs more often. So, summing up, labor markets in ECA are changing with non-standard employment increasing, the job tenure is shortening. Vulnerable groups appear to be the most affected by these trends, and the SP systems are not rightly organized around the prevalent employment relationship, but they are based on a model that is slowly disappearing. So the existing policies will need to be complemented in some way by measures that do not relate to the employment of individuals, but to the income of individuals. And let me just finish by discussing briefly how can these new, how can social protection systems change? So, as I said before, the systems of ECA have proven to be resilient and have proven to manage more or less well the shocks of the pandemic and the war in Ukraine, but they may need some change. And this change will imply a greater role of income protection and a lesser role for job protection policies. In fact, what we suggest is that there should be some kind of guaranteed minimum level of protection that is independent of the workers or the individual's labor market situation. And at the minimum, this protection, these programs should be mean tested to ensure they reach the poorest and those who face the largest shocks, not those who have specific characteristics. Because currently, the SP systems of ECA, if they give some kind of social assistance, is mostly on categorical non-targeted benefits. This is very different from a mean-tested approach, because this does not target the measures based on their income, but based on other things like having a child or being a war veteran, which may or may not be correlated with the income levels. So job losses and transitional unemployment should be insured by national unemployment income support programs, which do not exist in many ECA countries. Employment assistance programs and other labor market policies should be used to address labor displacements associated with structural changes like those of the green transition, but also can help population displaced by other shocks, like, for instance, Ukrainian refugees in Poland, the Syrian refugees in Turkey, or the return migrants in Central Asia. And lastly, the digital delivery and integration of the administrative data will help enhance the SP system's effectiveness. And let me just finish by mentioning that this whole report on social protection was based partly on these 5 background papers we wrote with several co-authors that you have there, and they have already all been published as policy research working papers. And please, you can go and download and find more information on the website of the report. Thank you very much.
Thank you very much, Colette and Ivan, for giving us a snapshot of the main point of the Europe and Central Asia economic update. We received several questions from viewers. Let me read actually 2 questions from the anonymous participant. Thank you very much for your questions, and ask perhaps Ivan and Colette to come to respond. First question is this. It seems very important that social protection can be separated from employment for ensuring safety net for those who those who really need the most. The report says employment assistance programs and other active labor market policies such as skill training, entrepreneurship support, and intermediation can be helpful to this end when well designed. Then how do you combine with labor regulatory adjustment and enforcement and social insurance to ensure equity and guarantee the public livelihood in consideration with their life stage, social environment, or upbringing or individual characteristics? That's the first set of points. The second one, subsidizing employment to the private sector may need to be tied to refugees and people with disabilities for functioning social protection. It also has possibility to be diminished to the significance of the protection, such as treating them as troublesome or relieving the intersectionality, such as picking skilled refugees among refugees. When it comes to migrant workers, their unstable legal status affects to the employment and life planning. Also, other social issues like social discrimination, family left in ascending countries, and crime like criminal intermediary are to be inclusive to the whole policy. How do you deal with these kind of complex issues? So we received a slightly complex question and comment on the migration and social protection. Ivan and Colette, if you have any comment response to this point, please come in.
I think these are 2 questions on social protection, so I will address them, Colette, if you're fine. So on the first question about active labor market policies, well, definitely active labor market policies need to be aware of the individual's particular, let's say, socio-cultural environment. And in fact, one of the things that we say in the report at some point is that SP systems in ECA, have different components. And one of them, for instance, is social care. They, which deals particularly with families and individuals in vulnerable situations. And what happens is that the social care services are not integrated into the bigger social protection system. So the social protection system doesn't work as a whole. So you may have individual, agencies within the government, within the public sector that are capable of, addressing the specific circumstances and understanding the socio-cultural environment of the individuals. but the system is not connected to them. So the agency that provides social assistance doesn't know about anything. So one of the recommendations we actually have in the report is the importance to create an integrated case management system that can bring social care services into the social protection system and connect them with the social assistance programs, the social insurance programs. So there's a, let's say, a more of a holistic view of individuals and their circumstances. And on the second question on migrants, so an important thing is that migrants should have some kind of legal status that allows them to work. And in that sense, the EU countries do have that. The temporary protection scheme of the EU for Ukrainian refugees provides them with allows them to work, and that's a great thing. Though, therefore, this is something that we think that other countries should also do. Usually refugees don't have the right to work, but it is the fact is that refugee crises usually do not resolve in the short term. They take a long time. So if individuals are going to remain for a long time in the host country, then the best way for them and for the host communities is for these refugees to work. Unfortunately, refugee crises do not solve themselves in the short term, and countries should be prepared to have refugees for a long time. This is how most refugee crises in the world happened. And even the refugee crisis, the current one, the previous one, 2015-16, of Syrian refugees mostly, they are still in Europe. They haven't gone back. So, and they're not going back in the short term. And even in the 90s, the refugees from the Balkan Wars, they stayed for a long time in the host countries like Germany or Austria. And only after the hostilities ceased, after 3 or 4 years of conflict, they gradually start to go back. So countries in the region need to be prepared that refugees will stay for a while, and therefore they need to accommodate them in a way that works.
Thank you, Ivan, for your responses. We have 2 to 3 minutes left in our seminar. So perhaps before wrapping up our seminar, I would like to ask Colette and Ivan to give us a very final, any additional messages to the viewers in Japan, and we wrap up. Colette, please.
Thank you all. I guess final message for me is really that we need to look past the nearer term of 2022 and start thinking about 2023 and how that outlook is going to shape up and what countries and governments can do now, put in place policies to help counter these adverse shocks and ensure growth in the coming years.
Great, thank you. Ivan.
Yes, my only general comment here, and this is a bit going from the policy recommendations, you know, if social protection systems are to be reformed to accommodate for structural changes and longer term trends that have changed the structure of the economies, countries do need to move to a system where it's really about the income and the living conditions of people that determine the need to protection, and not their employment or belonging to a specific category. Most social protection systems in ECA still are based still on categorical benefit programs, on employment-based contribution schemes, and these are not well suited to address both short-term shocks or longer-term changes in the structure of the economy.
Great, thank you very much. With us connecting to Washington, we have the pleasure of having Colette Wheeler, who is the senior economist in Prospect Report for Bank, and we had Ian Ture, who is the economist in the Office of Chief Economist for Europe and Central Asia region of the World Bank. Both of them give us a snapshot of the latest edition of the Europe and Central Asia Economic Update, subtitled Social Protection for Recovery. Thank you very much, both of you. Really appreciate it. And we are going to ask you. We are going to ask you for another round of the presentation in 6 months.
Thank you very much.
Look forward to it.
Great.
Thank you.
Thank you very much. Okay, today actually we are going to have one more round of the seminar virtually. This is going to be featuring the latest book titled Commodity Market, subtitles Evolution, Challenges and Policies. We are now having John Buffett and Peter Nagel from the Prospect visiting Tokyo, and we are going to have this seminar virtually. And also, actually, for those of you who are interested in coming to the World Bank Tokyo office in person, participating in the seminar starting at 1 p.m. This afternoon. So please stay tuned. And also, we have several more interesting seminars coming up in the next few weeks. So please check our website. Stay safe, stay healthy. Till next time. Thank you very much.
Thank you. Bye.
Bye.